You've spent a long time working with people who have made a lot of money, whether it's first generation, third generation. And I am really curious to understand not only how they've made the money, but more importantly, how they've kept the money and how they've grown the money, because it's something that a lot of people have this happen to them where they have this liquidity event where before that they were poor basically. They didn't have any experience with a lot of money, and then all of a sudden this money is dumped into their lap and they just don't know what to do with it. And unfortunately, especially in lottery and athletes, a lot of people, they end up blowing all of the money that they've made. And we want to inspire people to become financially literate. And so I would love to spend some time talking with you about that. So I'd love to know more about what you've learned. And if you have a framework or a structure for that, then, we could go through that.
Yeah, that's a fantastic question. And I would say I do think it depends to some degree how you came into the money, how much of a concern this is. I think there is this widespread conception of, okay, lottery winners are 5 years later much more likely to be bankrupt than the general population. And that probably is true. But I think to some degree, if you look at lottery winners or if you look at people who become pro athletes at the age of 23, you kind of have a selection bias there toward the people who are probably least prepared to handle a sudden windfall. You have somebody either who just, 22, 23, any one of us, our brains aren't fully mature by that point, and you've had very little life experience, and you've never paid your own bills. So I think there you're just coming in with your going, there's no training wheel session. Then lottery winners, by definition, it's people who are buying lottery tickets, the ones who are suddenly getting this. So they probably don't have the most rational economic framework to begin with. So I think if you're coming from a background which is significantly more common for somebody who generates significant wealth, as let's say an entrepreneur, or maybe you are a high paid employee at a tech firm, you're a high paid employee at a hedge fund, those people have a leg up there. Both have probably a little bit longer in their career and have more of this exposure to basic financial concepts. So the first thing is, I would say I wouldn't panic if you're in the situation saying, oh, by default, I'm going to blow it, and now I have to go hire Goldman Sachs and pay them 1% of my money every year just to prevent me from being my own worst enemy. I think it's perfectly fine if you want to do that. But if you talk to the wealth management industry, that's the only option. Whereas I would say that is a reasonable option and perfectly fine for those who want it. But also, people are very capable of managing their own money, even if it has two more zeros than it used to have. That said, I think in terms of, hey, what are the basics that people ought to do to protect from mistakes? I'd say there's a few things. And maybe I'll start with some of the ones that are a bit less obvious, maybe less sexy. One is to think about your insurance plan. One of the last things people want to think about, next to perhaps estate planning, which I can cover next. But if you think about your insurance plan, you know, there are a set of what they call very high net worth or very high net worth carriers. If you've heard names like Chubb, Pure, Berkeley One, AIG, and they are really designed for people whose liabilities might be, okay, I own a $5 million house, not a $500,000 house. Or if I'm getting sued by somebody, they see me as deep pockets, and so as a $10 million judgment, and you're going to have a different kind of liability there. And this insurance is a bit more expensive, but we're not talking 10 times more expensive. You're maybe going to spend twice as much as going with a mainline carrier like an Allstate or a State Farm. But really, one thing I think you'd want to do is find a broker who doesn't work for any one company, not a so-called captive broker, but somebody who will rate shop across all of them, but who is specifically focused on high net worth clients, and just say, hey, I need a basic insurance package. Again, this is nothing crazy. It's the stuff you're familiar with in terms of home insurance, auto insurance, et cetera. Although one key thing being umbrella insurance. A lot of people would not historically have umbrella. And basically what that means is your normal insurance goes up to, let's say, $500,000 of liability. It kicks in for literally another $5 or $10 million of liability above that. And it's shockingly cheap. We're talking maybe $1,000 a year, $2,000 a year to get $5 or $10 million of extra coverage. So very unlikely you'll actually have this problem. But in that circumstance where something terrible does happen and you have a $5 million judgment, you'll be very glad you spent $1,000 a year to be covered against that. So insurance is one piece.
Hey, business leaders and marketers. What if your brand could be featured right here? This ad spot could be yours. This channel is watched by a dedicated audience of ambitious founders, executives, and professionals who are actively looking for tools and services to help their business grow. If you want to put your brand in front of this highly dedicated audience that's difficult to reach, I'm currently looking for a few strategic partners for the channel. To learn more about sponsorship opportunities, click the link in the description. Let's grow together. Real fast, I want to ask you about this because this is something that's relevant for me now. Apparently, my parents took out a life insurance policy, a 20-year term life insurance policy on me 12 years ago when I was living in China, because
Yeah.
they were concerned about, if something happened to me, if I got really ill or if I died, they'd have to cover the funeral costs and going there and taking my body and all of this stuff.
Yeah.
And they want me to take over the policy now that I'm married. And so I'm looking at this and I'm like, what am I supposed to do with this policy? It's got 6 years after that. Like, I'll be 40 soon. So I'm like, do people have these life insurance? Like, do you hear these ultra high net worth individuals talking about life insurance? And like, do they put them into trusts? Do they put beneficiaries as individuals? Like, that stuff is super confusing.
Yeah, it's a fantastic question. I'd say the first thing, and if somebody takes away one thing from this, do not buy whole life insurance. The only person who is trying to sell you whole life insurance is someone who's getting a commission on whole life insurance. So you mentioned term. That's, of course, a different beast from whether they call it whole life, variable life, index universal life, all fancy ways of saying that you're going to pay a whole lot of commission and get something you don't really need. But within the term world, I think that really comes down, and this again should be quite cheap. If you're 40 and you want, I don't know, let's say $1 million of coverage, we are not looking at 5,000 a year or 10,000 a year. You're looking at more like 1,000 or 2,000 a year for that coverage. And that really just comes down to, do you have, if you were to get hit by a bus tomorrow, is that going to be a problem for someone else? Clearly it's a problem for Sean, but do you have enough money that your wife will be fine with just what's in your brokerage account? Or do you have little kids and now, your wife needs to raise those little kids and you're going to need an extra $4 million in order to get them through high school and college? That's really the way to think about it, is what time horizon will it be a problem for somebody that you care about if you pass away? And what is the gap between the assets that you're going to leave and the assets that are required? So it could well be somebody with a lot of money. Maybe if somebody has $5 or $10 million, but now they've bought 3 houses and they've got 4 kids and they've got, a set of people who are counting on them. Maybe they really do need, until their kids get through college or something like that, a significant policy. But I would say, if you are single or if you have enough money that when you pass away, that estate by itself is enough, then at that point, you don't really need term insurance. And, I was not, this idea of quote, permanent insurance, I don't, there's plenty of podcasts out there that really go down a rabbit hole on it. So we probably don't need to cover that too much more here. But what I will say by way of a data point is, in our community of about 7,000 people who are either very high or ultra high net worth and, pretty sophisticated in these things, pretty much nobody carries one of these permanent life insurance. There's a very special exception to that, something called private placement life insurance, which is really more of a tax planning vehicle than it is an insurance policy. But, we're talking $1 million minimum for something like that. So if you haven't been thinking about it, it's probably not relevant to you, but you probably will have at some point a broker come and talk to you about whole life insurance. And, I can tell you that north of 90% of people in the situation decide that's not a good trade-off for them.
Okay. So then, in the interest of time, I guess let's go on to the next thing that you were thinking about.
Yeah. I mean, I would say estate planning is another one that nobody wants to think about, but you should at least do the basics on. And there simplistically, there's a few documents. There's your will. Okay, what's going to happen to my kids, most importantly, and some other things like that if you pass away. And then there's things. There's something called a revocable trust, which really just simplifies the estate process if you pass away. There's some more complicated things where you get into things like irrevocable trusts, which, if you're in a situation, at least for your US listeners, there's a $30 million estate tax limit. More people will probably end up going over that than they think, because someone with $10 million today, if they're age 40, they're probably going to have more than $30 million by the time they pass away, because they have a lot of compounding in front of them. So you don't have to have more than 30 million today. But if you just do the math and say, okay, over 30 years, I might have 10 times the money. If you have 5 million today, you might actually get there. So think about it. And that, I'm not going to walk through hey, here's the exact playbook, but of course it depends on the person. But I think making a point of talking to a lawyer who specializes this, and they'll have a pretty straightforward playbook, unless you're trying to get really fancy and put bells and whistles on it. You're not going to rack up a massive bill for doing this, but it's something that's always better to be done earlier. And you want to just go ahead and work with a lawyer to set a basic practice there. So I would say that's kind of your infrastructure and logistics. We could talk a little bit more about the investments, which are probably, the sexier thing to talk about to begin with. But sorry, I think you had a question there, Sean.
I was just gonna say, in like one sentence for each
Yeah.
type, can you explain the difference between a revocable and obviously the term irrevocable and irrevocable are obvious, but what's the difference in the reasons why you would do one versus the other, like in a few sentences?
So a revocable trust does not really do anything or come into play until you pass away. And all it does is that in some states, when you pass away, if you don't have anything, then a judge goes through this probate process and you're just paying a bunch of legal fees and you're taking 6 or 12 months where assets where you wanted them to end up. If you have a revocable trust, when you pass away, it kind of comes to life and simplifies that process. An irrevocable trust, as it sounds like it's irrevocable, but it's a much more significant document where you, Sean, are actually giving money away today. You're putting this trust. You can't control it the same way you used to. You can't get it back the same way you used to. And that might sound terrible. And people don't like that aspect. What they do like is from a liability perspective. If you suddenly defraud me and I sue you, that's not actually your money anymore. So I can't get that money from you because it's in this trust. And from estate planning purposes, that money is out of your estate today. So if you put an Nvidia share in there today and it's worth $1, and then 10 years from now it's worth $100, your estate doesn't get taxed on that appreciation. It just gets taxed sort of at the value that you put in at.
Okay, so another question about infrastructure before talking about investments: domestic versus foreign companies, trusts, bank accounts. Um, Especially, there's a lot of Americans, I imagine, in your community. Some of them may be living in the US, some of them may not be. How are they on average thinking about this for tax purposes, for liability, for legal purposes and whatnot?
Yeah, I think there's some set of advisors who will advise you get really cute and be like, oh, set up this trust in the Cook Islands because nobody can ever come after you there, things like that. I think that's a pretty dangerous thing to do. The only reason that's relevant if you are doing something really shady and any proper legal system would come after your assets and now you've parked them in the Cook Islands. But, one, that's probably not ethical to begin with. Second, you're then trusting the Cook Islands legal system to protect your millions of dollars. And I think the risk that you did something really shady is probably smaller than that something shady happens in one of these shady countries. And now you don't have the recourse to a first world developed legal system to protect yourself. So I think that is a bit. I don't know many people who actually follow that. Let's just talk about the U.S. for a second. Within there's different states that have different rules. There's a subs. You talk to any lawyer, they'll tell you, okay, Nevada, South Dakota, Alaska. There's a Delaware. There's a few of these that are sort of better than structured than others. If you're working within a U.S. state, it's basically the same thing. And you're having a very reputable framework. So I would just follow my lawyer's advice there. I think I have trusts in Alaska and Nevada. In terms of outside the U.S., that's really something where it's probably going to be dangerous for me to be giving advice. I think if you live in Portugal and you have certain Portuguese implications, it depends on citizenship and a bunch of stuff, which is probably universal advice is more likely to lead someone astray.
Okay, I guess I was coming at it from the point of view of what have you heard of your community members doing, even if it's not legal advice.
So I would say most of them keep their stuff within US and within the place where the jurisdiction where they live. If they're in the US, they keep their stuff in the US. They're not taking advantage of foreign legal regimes. I think if you're in Europe, it's probably a little bit more specialized, partly because they don't have the global taxation. So as a US citizen, if I move to Monaco, I'm still paying US taxes. We are really the outlier there. If a French citizen moves to Monaco, they're no longer paying French taxes; they're just paying Monegasque taxes, which is nothing. So I think there is more playing around with those things amongst people outside the U.S. But I would say even they tend to stay within relatively established, developed countries. Maybe if you're going to Switzerland or Monaco or Luxembourg, but they're not going to your jurisdictions of convenience like Tuvalu or Micronesia, something like that. I think that's different a bit from if you are invested. Which is probably way too much detail. Investing in certain private equity vehicles, they're often domiciled in something like the Cayman Islands to avoid certain tax treatment. That's different from really like your own estate. That's more of a corporate thing for particular investments. That's not your holistic estate moving to the Caymans.
Okay. And so, what have you seen from your community members on average in how they structure their portfolio to, so I guess, are they on average thinking about growth or preservation? Like what's more important to them, growth or preservation right now?
Yeah, fantastic question, because I think anyone rational could look at this in one of two ways. You could say, all right, if I've been fortunate enough that I have, let's say, 5 times as much money as I need, you could either say, well, there's no need to take risks today. I can put it all in muni bonds. I can clip a 2% coupon, and that's going to cover myself, for the next 40 years. And I'm done here. I sleep well at night. Or you could say, hey, I have enough money that I could put it all in a triple nevered NASDAQ fund. And even if it drops 2/3, I still have plenty of money. And I think my expected value 30 years from now is much higher by doing that. And so I'm going to go highly risk on, and I'm going to accept the volatility and basically get paid for that volatility in the form of higher returns at the end. I don't think there's a right answer to that. I think that is largely a personality question. Now, to your question, hey, what do people do in practice? In practice, they take a much more risk-on approach. We do a annual asset allocation benchmarking survey and ask, hey, between stocks, bonds, cash, crypto, private credit, private equity, oil and gas, et cetera, where do you keep your money? And I'd say the bond allocation is well south of 10%. So if you hear of a quote typical portfolio being 60/40, in practice, I'll call equity like, so instruments with a high expected return but higher expected volatility are more like, real estate's maybe a quarter or a third of the portfolio, and then equities are almost the entire rest and just a sliver in cash and bonds. The flip side is it's not what I just said of, hey, a triple levered NASDAQ thing that's just, volatility to the moon. People actually are quite conservative on taking out debt and leverage. So your typical member, if they have a net worth of $100, they'll maybe have $5 in bonds, but they'll also have under $10 in borrowing. So half our members don't have a mortgage at all on their house. They basically say, hey, what money I do have, I'm going to put in a high return instrument and I'm going to be okay with the volatility, but I'm not going to risk the money I have for money I don't need. So they're not going to take out, debt that is total their net worth to double their exposure and take the risk that a down market actually could cause them to go bust and set back to zero, which I think is a pretty rational approach. Because if you put your money in stocks, maybe they drop 50%, but if you can handle that and you're not levered, you'll be fine. They'll come back from that 50% over the next decade. Whereas if you borrowed 50% and they drop 50%, you'll get a margin call and you're left with nothing, and you can never come back from nothing.
Something that's interesting to me, I've heard of only recently, is like basically, let's say you've got 5 million in your portfolio, and someone is willing to give you a $1.5 million loan or a $2 million loan. You kind of mentioned it, but basically, let's say the cost is 5% a year, and you know that you can put all of that money into an 8 to 12%, high dividend ETF. Would people do that, or would they avoid that?
Some people do it. I would say a key thing you said there is they're borrowing the amount they're borrowing. I think borrowing 10 or 20% of your portfolio is perfectly fine, because the way these loans work is, let's say you have, for simple math, $1 million portfolio. You're allowed to have debt depending on the brokerage you're working with of, let's call it 50, 60% of that. So let's say it's 60%. You can have 600,000. Now, if your portfolio falls by half, the amount you're allowed to borrow will fall from 600,000 to 300,000, because a consistent ratio. So if you borrowed half in the beginning, you're at a high risk of getting this margin call if it falls. If you only borrowed 10% to start with, so you only borrowed $100, the market would have to drop from a million all the way down to just 150,000 for you to get margin called. And even the Great Depression, that would be a sort of surprising scenario. So I think the 10 to 20%, there's plenty of people who do that, and that's not particularly aggressive. I think if you get over that for any sustained period of time, people in general don't do that because there's just too much risk from the volatility. In terms of how they use it, some people use it just to juice their returns by a little bit. As you said, okay, I'll borrow 10% and I'll put 10% more into, maybe it's just a broad index fund, maybe it's a dividend stock. Philip Morris or Altria is paying 7% and I'm borrowing at 5%, so I can clip that coupon. Over time, I'll do fine. I think that's reasonable. What's probably more common is to see that as an emergency fund, because you could say, hey, I need to have 10% of my money in cash at all times for opportunistic investments, for risk of, a medical problem, for something I want to buy, et cetera. But if you have that perpetual 10% in cash, that's going to drag down your long-term returns quite significantly over a long period of time. If instead you say, hey, I have the ability to access literally the same day $500,000 out of my $1 million brokerage account, I don't need to keep cash anymore. I can just wire myself the money if I need it, and then I'll pay it back on my own schedule. And that's actually a pretty common usage. And part of the reason I think that you see such a low allocation to cash is that cash is not a good long term investment. You are almost always losing money relative to inflation, or if you are making money, it's de minimis compared to what you could make elsewhere. So they avoid that cash drag, but keep the flexibility, which that's the way that I use my portfolio line of credit.
So when these people are thinking about this risk on type investment, as you were saying, they tend to be more aggressive. What are they looking for? What are they investing in?
Um, a lot of that is going to come down to, personal nature. Broadly, I would say there's two ways that people approach this. One, and this might be your, classic engineer mindset, is I'm going to look at this in a really rigorous way. I'm going to do research and say these 10 assets have this 10 historical returns and they have this correlation to each other. And I'm willing to accept, there's the so-called efficient frontier for every extra percentage point of volatility that you're willing to accept. How much extra return are you expecting to get? And they'll have a very strategic, I'm going to reallocate my portfolio every quarter to keep each percentage in line, and this much in domestic stocks, this much in international, this much in precious metals, et cetera. Um, that in theory, I think is a great practice. And in practice, maybe a quarter of people do it that way. What I think is more common if you're really talking with people is they take a little bit less strategic and a little bit more opportunistic approach of, okay, I heard about a great private equity investment. I'm going to put 1% of my money or 3% of my money in that P investment. And then maybe next month I see this other opportunity here. Or I really like, Bitcoin's fallen 80% and I'm a believer in Bitcoin. I'm going to, put 1 or 2 or 3% of my money into Bitcoin. And so they will look at it more from a ground up level of individual investments they like. And as long as their portfolio in aggregate is somewhat reasonable. Let's say they put a bunch of money into Bitcoin at 10x, they're probably going to trim that position to, keep it at a allocation that lets them sleep at night, but not, consistently rebalancing toward these optimal dynamics. I would say that's probably the more common one. In terms of the kinds of investments that the specific things that people are investing in, public equities for everybody or almost everybody is going to be the biggest piece of their portfolio. I think if you're somebody who's not very high net worth, so let's say you have a 100,000 portfolio, really public stocks are the best way to do that because you can get in at any minimum price and you're going to get very good returns in the long term. If you start to get into a 7 or an 8-figure portfolio, you do find that their so-called alternative asset or their private market exposure goes up in correlation with their net worth. So whereas your average person with $1 million may have, I don't know, 5 or 10% alternatives, as they get to maybe being a 10 million or 20 million or 50 million portfolio, their private equity allocation is going to go up significantly. And basically, it's what private equity versus public equity mean is right there in the name. Public equity means that you own a share of a public company like Apple or like Microsoft, whereas private equity is you own a share of a private company. So you can't go to the New York Stock Exchange and actually buy and sell that. It's a lot more illiquid. But if you look, we could get into a debate about this, but I think it's fair to say that on average, historically, the returns of private equity have been somewhat higher than public equity. Not 3 or 4 times as high, but if public equity is delivering 8 to 10%, maybe private equity is delivering 10 to 12%. It may sound de minimis, but if you say, hey, an extra 2% a year on $1 million for 20 years, that actually compounds to being real money.
So are they holding an asset, like you said, when they see that the profit looks nice, they'll take it out, and then are they taking it out because they have conviction and there's another investment they want to move that money into, or are they taking it out and then looking for an opportunity and sitting on the cash or moving it into something safer while they're looking for that opportunity? Like how do they manage that portfolio?
Yeah. Again, different people, different approaches. But if I took the median or the modal person, they are probably more trimming a position when it has been too successful and just become an element of their portfolio that's making them nervous. They say, okay, I made this great bet on Nvidia, but is now half my net worth is in Nvidia. I still like the company, but I just don't feel comfortable with half my net worth being there and there could be some black swan event tomorrow that causes that to fall by 50%. And I'm going to be really unhappy if that happens. I think that's the more common thing of people say, hey, this is just too big. I'm going to trim it and I'll look for somewhere else to put it. Um, your most strategic person, who's probably not me, but there are these people out there, is going to take a little bit more of that disciplined. Okay, I now found opportunity number 4, which is more attractive than opportunities 1, 2, and 3. So I'm going to sell a little bit of 1, 2, and 3 and rebalance into 4, and again, improve my kind of total portfolio composition there. I just wouldn't hold yourself to that standard. Maybe that's sort of a journey you try and get there over time. But I think a lot of people are more in that just, I'm going to sell something when either I lose it becomes too big, or I lose conviction in the stock. They might say, hey, I was a big believer in Apple, but now Steve Jobs passed away and I don't like this Tim Cook character. Now, in retrospect, that was a terrible choice. Tim Cook was great, but stuff can change. Or maybe you say, hey, I don't, I've got a bunch of Altria stock I inherited, but I think cigarettes hurt people. So I'm going to sell that Altria stock just because I don't feel good owning it. There could be a lot of reasons to do that. Now, one thing that's interesting is, especially if you're in this concentrated position, which is fairly common in our community, of somebody either started a company or they've been an employee at a company that's done very well for a long time. So now they have a huge amount of any of the names you think of, Google, Microsoft, Facebook, Nvidia, et cetera, where that was most of their compensation, is now they have this stock that represents too much of their portfolio. And then the challenge with that is you could say, okay, it's clear I should trim this, I should sell some, but I'm going to incur a huge tax bill if I do this. How do I trim this position without paying $1 million of taxes here? And there are a couple of ways to do that. Simplistically, basically 3 things you could do. One is, if you're charitably inclined, you can give that money away. And so if you donate $1 million of Apple stock, you will get full tax credits for having donated $1 million, but you don't have to pay for the appreciation that went from you paid 1,000 to buy it and it's now worth $1 million. You never pay the kind of tax on the gain, but you get a tax benefit on the donation part. So you still have less money you had before. To be clear, you gave away the money, you don't have it. But if you wanted to support a cause anyway, that's a much more efficient way to rebalance your portfolio and provide that charitable support you want. So that's a fantastic thing to do. And a donor advised fund is often a good way to do that. So one is to give away the appreciated stock. A second one is what's called an exchange fund. And what that looks like is, let's say I've worked at Exxon, you've worked at Apple, and a third person over here has been working at Bank of America, and all 3 of those stocks have gone up. Each of us is overallocated to our own stock, but we basically form a pool. I put in $1 million of Exxon, you put in $1 million of Microsoft, he puts in $1 million of Bank of America, and then we each own a third of this now diversified portfolio of stocks. And actually, the way the laws work, at least in the US, after a certain number of years, I believe it's 5 or 7 years, you can take out a third of each of those shares, and you never actually had to sell any of them. So you become diversified without actually having a sales transaction. And if you look online, there's different, just look for exchange fund. There's different providers that offer exchange funds. A third option is what's called direct indexing. And indexing, as I'm sure you're familiar, is basically, if you want to own the S&P 500, you're getting exposure to 500 companies, as is in the name, or the FTSE 100 in England is roughly 100 companies. Now, direct indexing is, rather than buying just a portfolio from Vanguard, you actually directly buy every one of those 500 shares. Now, I might say, well, that seems like a lot of complexity for no real point. But the value of that becomes, today I buy 500 shares, but then just the nature of the markets, some will go up and some will go down. So let's say Exxon goes up and Chevron goes down. They are going to be highly correlated. But what happens is, you can sell your Chevron shares and recognize a loss on Chevron, and then buy Exxon shares in their place. So your portfolio returns won't really change, because in the future, when Exxon goes up, Chevron's going to go up at the same pace. So you'll get the same long-term returns, but you're able, as you go, to continually sort of recognize and lock in these gains. And you can use that to then offset the gains that you're making when you sell your concentrated position. So over a course of several years, you're able to make those sales and deconcentrate your position, and basically manufacture offsetting losses, so you don't have a big tax bill along the way. And again, if you look up direct indexing, for example, there's a company called Freck, who I've worked with a bit to manage that.
Is there anything I haven't asked that you feel is really important to share?
Um, I would say the last thing is, if you're in this position of having a significant wealth change or windfall, to recognize recognize one, that nothing important is really going to change. And what I mean by nothing important is, let's say you have a bad relationship with your kids adding a bunch of money to that is not going to turn that into a good relationship, or hopefully you have a good relationship with your kids or a good relationship with your spouse. Adding a bunch of money is not going to change that good relationship. Same thing if you are healthy or unhealthy, adding a bunch of money, if you're happy or unhappy, it's not going to change that. So I think that in some way, if you look at all the things people in our community discuss, it's the same thing that they were discussing before. How do I raise my kids well? What are good? How do I stay healthy? That kind of stuff. How do I find meaning in my life? It's not those fundamental changes. And so I'd say don't kind of put pressure on yourself in that way. But I would say the flip side is also don't feel a pressure to just do something quickly. A lot of people will advocate taking a 6 or 12 month cooling off period. Don't make any major investments. Don't make any major purchases. You often hear this advice after somebody's spouse passes away that, a widow shouldn't say sell her house within the first 12 months, really see if she likes living there independently before deciding to sell it. And I would say it's the same thing here. I think there can be some temptation of, oh my goodness, now I'm managing $10 million. I'll throw $1 million here, $1 million there at this cool venture capital fund or this cool private equity fund. And then after 6 months, you've actually put half your money into stuff you didn't really research that well and aren't necessarily happy with those decisions. So I would just start a little bit smaller, put 1% or half a percent into a position, not 5 or 10%. So you get a little exposure and experience and decide what you like without having made huge investments or, again, huge spending. I wouldn't spend half my money buying a new house. I would either take my time or make some smaller purchases relative to whatever that amount of net worth is.
Thanks for watching. If you liked this insight, I've handpicked another video for you right here on the screen. For more actionable strategies that get you real results, hit subscribe.